Today on the Liam Hyland portfolio, we have a lot to unpack over this past week. A ceasefire with Iran, oil crashing 16% in a single day, the Dow posting its best session since last April. We've got Amazon CEO telling the world their chip business is worth $50 billion. And we have Meta launching a brand new AI model and signing $21 billion in infrastructure deals. And right now, JD Vance is heading to Islamabad for the highest level US-Iran talks since 1979. And then we also have Wells Fargo saying they no longer expect any rate cuts in 2026. Goldman Sachs saying tech is the cheapest it's been in 50 years. JP Morgan putting out a $145 price target on Tesla, implying a 60% downside. And bank earnings are starting on Monday, which Goldman have called the definitive litmus test for whether the March sell-off was a buying opportunity or just the start of something deeper. I'm going to walk you through all of this, show you how it's affected my portfolio, and tell you exactly what I'm watching for next week. Welcome to the Liam Hyland portfolio. I'm Liam, a chartered accountant documenting the build of a real stock portfolio in public. This is not financial advice. This is just my own analysis of the market and the positions I hold. So to kick things off, on Monday, we had the Wells Fargo Investment Institute come out and say they no longer expect the Fed to cut interest rates at all in 2026. No cuts for the entire year. They had previously been forecasting 2 rate cuts. Citigroup still think rate cuts are coming, but they have pushed out their timeline by 3 months, going from June to September, now from September to December. Now, after Wednesday's ceasefire rally, there was a repricing. Traders saw about 39% chance the Fed could resume cuts later this year. Yields dropped. The 10-year fell to 4.25%. So where does this leave the portfolio? Well, it's still sitting with 34% in cash. The remaining 66% is almost entirely growth compounders. My holdings benefit most when borrowing costs come down, or at least are expected to come down in the near future. If the ceasefire holds and oil normalizes and the Fed eventually gets the room it wants to cut rates, this portfolio is very well positioned for that environment. If not, patience continues to be the right call. All right, so let's talk about the biggest story of the week, because the sequence of events over the past 72 hours is genuinely remarkable. On Tuesday, Trump had given Iran an 8 p.m. Eastern deadline to reopen the Strait of Hormuz. He threatened to destroy power plants, bridges, and said that the whole civilization would die tonight if no deal was reached. Markets were falling. Oil was above $115 and everyone was bracing for major escalation. And then, less than 2 hours before the deadline, Trump posted on Truth Social that he was suspending attacks for 2 weeks, subject to Iran agreeing to the complete, immediate, and safe reopening of the strait. The market reaction to that news on Wednesday was enormous. The Dow, S&P 500, and NASDAQ all up big on the day. Oil fell 16%, which is the biggest single-day drop since April of 2020. Travel stocks went up through the roof. Carnival up 11%, United Airlines up 8%. But throughout the week, cracks kept appearing. Iran's parliament speaker claimed the US violated 3 of their 10 conditions. Israel launched some of its heaviest strikes in Lebanon, killing over 250 people. Iran briefly claimed it reclosed the strait. Vice President Vance himself called the truce fragile. So while the market took that news as a reason for a massive rally, I took none of it as a signal to deploy cash. I viewed it as the market pricing in a possible resolution, not a confirmed one. The talks in Islamabad begin today. The ceasefire expires April 22nd. That's 12 days from now. And the gap between the two sides is enormous. Now, here's where this gets interesting for my portfolio, because we got a massive amount of AI-related news that directly touches my biggest positions. Let me start with the Goldman Sachs note. On Tuesday, Goldman published a research note saying tech stocks are trading at their cheapest valuations relative to their growth in 50 years. Their argument is that the tech sector's price-to-earnings growth ratio, or PEG ratio, is now below the broader market. You are paying less per unit of expected growth in tech than you are in things like consumer staples, industrials, or consumer discretionary. They pointed out that tech earnings per share is still expected to grow at 44% in Q1, accounting for roughly 80% of the total S&P 500 earnings growth. They illustrate the record gap between the performance of the stocks and the underlying earnings. Now, just looking at my holdings, for example, we have Amazon at 10% of my portfolio. And we've had Andy Jassy releasing his annual shareholder letter, and boy, was it a statement. Amazon's custom chip business, covering Graviton, Trainium, and Nitro, now has a $20 billion annual revenue run rate, growing at triple-digit percentages. Jassy said if they sold those chips on the open market like Nvidia does, the business would be worth roughly $50 billion a year. AWS AI revenue has hit a $15 billion run rate. Trainium chips are sold out. Trainium 3 is nearly fully subscribed. And Amazon is planning $200 billion in capex for 2026 alone. Jassy's exact words were, they're not investing $200 billion on a hunch. Now, Amazon's been one of those positions where it's been trading sideways for some time, but the stock jumped 5.6% on this letter. For me, that's a meaningful move on a 10% position. But more importantly, the Jassy letter gave me more confidence on this holding than I've had in months. The chip business alone changes the economics of AWS entirely. If they start selling chips externally, which Jassy hinted at, this becomes a completely different story. And continuing with my holdings, we have my Meta position, which improved dramatically this week. On Wednesday, Meta launched MuSpark, the first model from its Superintelligence Labs unit. The stock jumped 6.5% on that news. Then on Thursday, CoreWeave announced a $21 billion expanded deal to provide AI cloud capacity for Meta through to December 2032. This is on top of the $14 billion deal from last year. That's $35 billion committed to CoreWeave alone. And again, Meta stock rose another 2.6%. So in 2 days, we have Meta move about 9% in total. For me as a shareholder, that combination of MuSpark and the CoreWeave deal tells me Meta is shipping AI products and investing seriously in the infrastructure to scale them. And yet Meta carries a forward PE of 19, and this is a company growing revenue at 20%. Then there's Google. This is my best performing position. And there was big news earlier in the week. Broadcom signed a long-term deal to develop Google's custom AI chips through 2031 and expanded its deal with Anthropic for 3.5 gigawatts of TPU-based compute starting in 2027. Anthropic's annualized revenue has now passed $30 billion, up from $9 billion at the end of last year. Google's TPU infrastructure is powering a significant chunk of that growth. Multi-year commitments through 2031 give real revenue visibility. This validates the AI monetization thesis for Google Cloud. But not every holding is a stock market darling like Google is, because the next one we have is Microsoft. This is the one that continues to get little love from the market. The business is performing. Cloud revenue grew 26%, Azure grew 39%, but the stock has barely moved this week. The market is still digesting the $37.5 billion of capex in a single quarter. And at a 23 trailing PE though, with that kind of growth, the Goldman note applies squarely to this position. Now let me address the one position with the most question marks around it. On Monday, JP Morgan analyst Ryan Brinkman put out a note reiterating his underweight rating on Tesla, giving it a price target of $145. That's a 60% downside call. His note came after Tesla's results showing the continued decline in EV and energy storage sales. His core argument is nothing new, it's that the stock is completely disconnected from operating performance. Earnings expectations have collapsed, and yet the stock has risen 50% over the same period. And I don't disagree with him. I share the same views of that dislocation. I view Tesla at its current valuation as an absolute deeply out of the money call option on the future of autonomy and energy. Given that, I position my holdings accordingly, capping it at 3% of the portfolio. And so this is one that's in a wait and see position. The Cybercab has entered initial production. Robotaxi is being tested. Optimus is in development. And then there's also the Terafab deal with Intel announced this week, where Tesla is partnering on a massive chip manufacturing project. But all of these are future revenue streams, not current ones. And in a higher for longer rate environment, which we're currently experiencing, future earnings get discounted more heavily. Now, does a note like the one from Ryan make me consider selling? No, I'm not selling. I'm fully aware of that disconnect between the valuation and the fundamentals, and I've sized the position accordingly for that risk. Among the 54 analysts covering Tesla, only 10 have a negative rating. The consensus target is around $360. So JP Morgan is the extreme bear case. But Tesla reports Q1 earnings on the evening of April 22nd. That is also the same day as the ceasefire expiring. So we could get Tesla results and a potential resumption of the war on the same day. That's a lot of uncertainty compressed into that single date. Now let me wrap it up by telling you what I'm watching heading into next week, because there are 3 things that I think will determine whether this rally can be sustained. Number 1, we have the Islamabad negotiations, right? The talks begin today. Vance is leading the US team. The ceasefire expires on April 22nd. Iran wants controlled Hormuz passage, withdrawal of US forces, lifting of all sanctions, while the US wants zero uranium enrichment, permanent Hormuz reopening, dismantling of nuclear facilities. These positions are not even close. What I'm watching for this weekend is whether both sides actually sit down and whether there's any signal of a framework for extending that ceasefire. If we get that, oil will fall further and the rally will continue to extend. If not, we're back to Tuesday's fear very quickly. Next, I'm watching the bank earnings with JP Morgan and Goldman Sachs both reporting, and then we have Bank of America and Citigroup reporting after them. And really what we're focusing on there is just around the net interest income, credit quality, and deal-making activity. If banks show strong lending and stable consumer credit, that sets a floor. If they show strain, it confirms the damage. And then lastly, we have the CPI aftermath. The question now is whether the Fed will treat this as a transitory energy shock or something more persistent. The Fed meets in April. Nobody expects them to move, but the language they use will tell us everything about whether rate cuts are still possible later this year. And so where does all of this leave me? Well, I've got Goldman Sachs telling me tech is the cheapest it's been in decades. I've got Amazon telling me their chip business is on fire and growing triple digits. I've got Meta shipping competitive AI products and signing $35 billion in infrastructure deals. I've got Google locking in AI chip commitments through 2031. These are all quality businesses at compressed prices. But on the other hand, I've also got oil still near $96. Wells Fargo said no rate cuts this year. The ceasefire is fragile. Iran's parliament is making threats. And next week's bank earnings have yet to be reported. So in terms of my stance, if the Islamabad negotiations this weekend produce a credible framework for extending the ceasefire, and if bank earnings next week show the economy is intact, those 2 things together could be enough for me to start putting cash to work. A lower stock price and a better buying opportunity are not automatically the same thing, but they're getting closer to being the same thing than they've been at any point in the last 2 weeks. And with more clarity coming around these negotiations and the economy with the bank earnings, that will give me the kind of signals and information I need to know if we're going to start deploying more cash in the coming weeks. Thank you for watching. If you found this useful, like the video and subscribe. I'll see you in the next one.